Imagine packing a massive restaurant to the absolute brim.
Right, standing room only.
Exactly. You've got 76 million customers, the line is wrapping around the block, and foot traffic is up like 6% year over year.
Sounds like a gold mine.
You would think so. But instead of popping champagne in the back office, management is standing at the front door, actively and intentionally kicking out 30% of their most loyal, everyday regulars.
Just showing them the door.
Yeah, literally looking at the crowd, pointing to the mass market consumers, and telling a third of them to take their business somewhere else.
It sounds completely counterintuitive when you put it like that.
It really does. But welcome to the Stock Ticker's deep dive into Santander Brasil's Q2 2026 earnings. The ticker symbol is BSBR. And today we were looking at a masterclass in balance sheet defense.
Which is fascinating because the strategy at play here really just shatters that traditional linear equation we always hear, which is that growth automatically equals success.
Right, exactly. And our mission today is to break down this earnings call for you, the retail investor. We're going to look at the headline numbers, the brutal de-risking story behind those numbers, and the management guidance that honestly shocked a lot of analysts.
Yeah, it forces you to completely reevaluate how you measure a bank's health, especially in an emerging market like Brazil.
So let's get straight into the raw data, because the headline numbers map out the exact paradox you're talking about. Santander Brasil posted a recurring net income of 3 billion Brazilian reais.
Which, on a nominal basis, I mean, 3 billion is a literal mountain of cash.
Oh, massive.
Yeah.
But the market isn't pricing nominal cash, right?
Yeah.
It's pricing the efficiency of the capital.
Exactly.
So that 3 billion translates to a 12.5% return on average equity, or ROAE. Now, for an investor looking at, say, European or North American banks, a 12.5% ROAE might look, well, perfectly stable, maybe even an attractive yield.
Right, in a low-rate environment, sure. But in the Brazilian context, 12.5% basically means management's feet are being held directly to the fire.
Yeah, break that down for us. Why is 12.5% such a highly pressured number there?
So the Brazilian macro environment completely changes the math on equity risk premiums. You have to look at the Selic rate, which is Brazil's benchmark interest rate.
Right.
When your baseline risk-free government bond is yielding double digits, the cost of capital is just astronomically high.
Because why would you take a risk when you can get a guaranteed double-digit return?
Yeah, exactly. If an institutional investor can park their capital in sovereign Brazilian debt and pull a massive guaranteed yield, a retail bank taking on the heavy, messy risk of consumer and corporate lending needs to deliver significantly more to justify that equity risk.
So what's the historical benchmark they want to see?
Historically, the market demands an ROAE closer to 16 to 20% for a Brazilian bank to be considered highly competitive. So delivering 12.5% essentially offers this tiny, almost negligible premium over the risk-free rate.
And to his credit, the CFO, Carlos Muniz, he didn't try to spin it on the call.
No, he was incredibly direct.
He was remarkably blunt. He attributed that 12.5% directly to a severely challenging macroeconomic environment and an elevated cost of risk.
Yeah, he's openly acknowledging that the bank is carrying a massive capital base, but the engine just isn't converting that capital into high-octane profit at the rate it used to.
Right. The engine is stalling a bit, and the underlying mechanics of that stalled engine show up in the top-line paradox we mentioned at the start.
Client growth versus the revenue.
Exactly. They grew their total customer base to 76.2 million, which is that 6% increase, but the efficiency ratio is sitting at 39.3%.
Which is the tension point right there.
Right, because in banking, you want that ratio, which is your operating expenses divided by your net revenues. You want that to be as low as possible.
Exactly.
So if the ratio is strained while the customer count is rising, I mean, the immediate assumption is that the bank hired too many people, right?
Yeah.
Or they just blew their budget on marketing to acquire all those clients. It's like they're packing the restaurant, but nobody is ordering appetizers.
Right, but the transcript specifically invalidates that expense runaway theory. Muniz detailed that administrative and personnel expenses were actually kept strictly below the inflation rate.
So they are overspending.
No, they are operating very lean. The friction in that efficiency ratio is entirely on the denominator. It's the revenue dynamics.
Oh, okay.
They are bringing in millions of new clients, yes, but the revenue generated per client is compressing.
Because of the strategic shift.
Exactly. It's the cost of this deliberate pivot they are executing. The new clients they are prioritizing simply do not generate the massive front-loaded interest income that their legacy subprime clients did.
And you can really see that net interest margin compression in the data. They noted a 10 basis point drop in their spread this quarter.
Which is significant.
Right. I mean, 10 basis points, 0.1% might seem like a rounding error if you're just looking at personal finance.
Yeah.
But when you apply it across a loan portfolio worth hundreds of billions of RAS.
It carves a massive chunk of operating profit right out of the bottom line.
Yeah, exactly. And they pointed to two specific culprits for this, right? Deferred expenses from their banking correspondents and lower funding results from a dip in the average CDI.
The CDI dynamic is so crucial here.
Yeah, let's demystify that for the listener, because it impacts profitability before the bank even underwrites a single consumer loan.
Right. So the CDI, Certificado de Depósito Interbancário, is the benchmark interbank lending rate in Brazil. And it tracks virtually identically with the central bank's Selic rate.
Okay, so it's the baseline rate.
Yes. Now, a bank the size of Santander Brasil holds an immense amount of structural liquidity. We are talking about tens of billions in depositor cash and capital reserves that just haven't been deployed into active loans yet.
That money isn't just sitting in a giant physical vault,
Exactly. It's not sitting in a vault. The Treasury Department parks it in overnight interbank lending and short-term liquid assets tied directly to that CDI. And they do that to generate a risk-free return.
So when the average CDI rate drops, like it did this quarter,
the yield on that massive pool of structural liquidity compresses instantly.
Wow, okay. So the spread on the actual loans they make to consumers might remain perfectly stable, but because the baseline yield on their idle cash just dropped, the overall funding margin gets squeezed.
That is the exact mechanical drag on the top line. And then you combine that with the accounting treatment of their banking correspondence.
Right, the geographic footprint issue.
Yeah, in a country as geographically vast as Brazil, building physical brick-and-mortar bank branches in the interior, like the Amazon basin or the rural Northeast, is just economically impossible.
So they use correspondence.
Exactly. These are local lottery kiosks, post offices, supermarkets. They act as authorized agents, processing deposits, withdrawals, and basic loan applications for the bank.
The setting that up isn't free.
No, setting up and maintaining that vast third-party network involves significant operational costs. And the amortization of those deferred setup expenses hit the books this quarter, which acted as a secondary weight on the overall spread.
Okay, so the baseline environment is actively fighting them. The risk-free yield on their cash float is down. And the operational cost of maintaining their geographic reach is biting into the margins.
Yep, they're getting squeezed.
But, and this is where it gets crazy, that spread compression is really only half the story. The real revenue squeeze is completely self-inflicted.
Yes, it is.
And this takes us into the most shocking data point of this entire call. Management revealed a 30% reduction in exposure to the low-income segment over the past 12 months.
Which is just a massive number.
30%.
Yeah.
And they define this segment as individuals making under 4,000 reais a month.
A 30% reduction in a core demographic portfolio over a single year, that is not natural attrition. That is a violent structural amputation.
Right. I mean, if you look at the mechanics of shrinking a portfolio by that magnitude in 12 months, you aren't just like letting old loans gracefully expire.
No, not at all.
You are actively freezing credit limit increases. You are aggressively declining new card applications. And you are likely bundling and selling off tranches of non-performing subprime debt to third-party collection agencies just to get it off the balance sheet entirely.
They are purposefully walking away from the mass market.
So why are they doing this?
Yeah.
Walk us through the macroeconomic realities forcing this amputation.
Well, 4,000 reais a month is roughly $700 to $800 right now. And in the current Brazilian economy, when you factor in persistent heavy inflation in food, housing, energy, a household operating on that income has virtually zero discretionary liquidity.
Right. Every cent is spoken for.
Exactly. When you look at the household debt-to-income ratios across the broader Brazilian economy, the mass market is literally suffocating under leverage.
Wow.
So if a bank continues to issue unsecured personal loans or high-limit credit cards to that demographic, they aren't originating assets anymore. They're just originating future defaults.
Muniz used a very specific phrase on the call. He said they are prioritizing macro returns and safe origination over blind market share.
Which is a total rejection of the standard playbook.
Exactly. It's a total rejection of the vanity metrics that usually drive emerging market banking narratives.
So?
I mean, for years, the story of Brazilian fintech and retail banking was all about the race for the unbanked.
Oh, yeah. Who can issue the most purple cards? Who can onboard 10 million users the fastest?
Right. But Santander's looking at the board and saying, we actually do not care if we lose the user count race because half of those users are going to default.
Yeah, they're prioritizing the integrity of the capital over the size of the footprint. It's a total repudiation of the growth at all costs model.
But here's the catch. If you amputate your highest yielding subprime credit cards, you have to replace that revenue stream somehow.
You do, which perfectly explains their aggressive pivot toward the high income and the secured client.
Right, the data shows a complete rewiring of their underwriting engine here. They reported an 8% growth in their select high income segment. But more importantly, the collateralization of the bank is surging.
The shift into secured lending is just staggering.
Yeah, run through those numbers because they are wild.
Okay, so home equity loan origination is up 40% over a 12-month period.
40%.
Right. And in the SME sector, small and mid-sized enterprises, 40% of that entire commercial portfolio is now backed by hard collateral.
And the consumer finance stuff, too.
Yeah, their consumer finance division, particularly auto loans, underwent a total transformation. Historically, new vehicles only made up about 7% of their auto origination.
Mostly used cars before.
Exactly. But today, that number has tripled to 22%. And a lot of that is being heavily driven by the financing of new electric vehicles, which require substantial down payments.
So the underwriting mechanics between these two worlds, the unsecured mass market and the collateralized premium market, are just night and day.
Completely different paradigms. An unsecured personal loan to a mass market client relies entirely on cash flow modeling.
Right, hoping they get paid next month.
Yeah, and if that client loses their job or gets hit with an unexpected medical bill, the bank takes a total loss. There is nothing to recover.
Zero.
But a home equity line of credit or a heavily collateralized SME loan, the risk profile drops off an absolute cliff.
Because if the SME defaults, the bank just seizes the commercial real estate, right? Or the heavy machinery backing the loan.
Exactly. If the EV buyer defaults, the bank repossesses an easily liquidated, high-value asset. They are willingly trading high-yield, unsecured risk for lower-yield, collateralized safety.
And that trade-off is the core of the strategic paradox here.
Yeah.
Because the CFO explicitly addressed the structural spreads of this new demographic. High-income clients are undeniably safer, but their spread is roughly half that of the low-income segment.
Which makes perfect mathematical sense if you think about it.
Right. I mean, a wealthy client with pristine credit and significant assets isn't going to accept a 60% APR on a personal loan.
No, because they have leverage.
Exactly. They will shop their mortgage, their auto loan, their wealth management across Itaú, Bradesco, BDG Pactual. The bank has to offer hyper-competitive compressed rates to win that business.
So mechanically, if you trade one subprime borrower for one high net worth borrower, you just cut your net interest margin on that specific unit of capital in half.
Half. So if rich clients are safer, but the margins are cut in half, how does the bank survive that margin compression?
Well, the only mathematical way to survive a 50% margin compression is to double your volume with that specific client.
Ah, volume.
Right, which brings us to the concept of primacy. And the transcript leans heavily on this. The bank cannot survive if it is just a secondary credit card sitting in a wealthy client's wallet.
Right, pulling it out once a month for a dinner.
Exactly. To make the economics of the select high-income segment work, Santander has to become the client's primary operating system. They need the payroll deposit, the investment brokerage account, the auto insurance policy, and the mortgage.
It's about capturing the entirety of the client's financial friction.
Yes, the whole ecosystem. And the most critical component of achieving primacy is capturing the transactional deposits.
Because that's the cheap money.
Right. If Santander becomes the primary hub where a client parks their daily cash, The bank gets access to essentially zero-cost funding.
And they can lend that free cash out, which
Wow.
mathematically offsets the lower spread they are forced to offer on those secured loans.
Exactly. But even with deep cross-selling, operating on tighter margins requires stripping out overhead.
Yeah, and the transcript highlighted a massive operational win here. They reduced the cost to serve the low-income segment by 30% over the last 2 years.
30% is huge. And that level of operational leverage is really where the technological infrastructure comes into play. The management team stated that 100% of their employees now have access to artificial intelligence tools.
Okay, but we need to look past the buzzword here, right?
Yeah.
Because every company says they use AI now. Let's examine the actual operational mechanics of AI in a banking environment.
Yeah, this isn't just about deploying chatbots to handle password resets. It's about predictive modeling and automated underwriting.
Right. If you map out the traditional cost to serve, a massive portion goes to human underwriters reviewing borderline credit applications or, call center agents manually cross-selling products.
Exactly. But by deploying AI, the bank is analyzing the transaction ledger in real time.
So the models can literally see a client making a high-interest payment to a competitor's credit card.
Yes, the AI sees that, automatically calculates the risk profile, and pushes a pre-approved lower-rate balance transfer offer directly to the client's mobile app.
Without a single human employee ever touching the file.
Exactly. The operational cost of originating that new loan drops to fractions of a cent.
That's incredible. Furthermore, when you shrink your physical footprint and push your mass market clients into a purely digital automated service environment, the fixed costs of maintaining branches and human tellers just plummet.
Right. They are aggressively protecting their margins by substituting human operational costs with scalable software.
So the de-risking strategy is logically sound. You cut the unsecured subprime debt, you pivot to wealthy clients, you demand collateral, you push for primacy, and you use AI to slash the cost to serve.
On paper, it's brilliant.
But a bank can't just wave a magic wand and instantly transform its balance sheet overnight.
No, unfortunately.
You still have to deal with the legacy portfolio. The millions of unsecured loans written during the aggressive growth phases of 2023 and 2024. And this quarter, Santander is taking a significant financial hit to clean up that exact baggage.
The transition period is always the most painful, right? You are dealing with the runoff of the old strategy while waiting for the new strategy to scale. And the immediate pain points are highly visible in their provisioning data.
Yeah, they took a specific 700 million reais one-off provisioning hit this quarter.
700 million.
And we should clarify, in banking, a provision for credit losses isn't cash going out the door today, right?
Right. It's an accounting recognition of future reality. It's the bank looking at a specific tranche of loans and mathematically accepting that the money isn't coming back.
So that 700 million reais is pulled directly out of their net income. And the CFO isolated the source of this hit to two specific areas. First, isolated wholesale banking cases. And second, an inventory adjustment for a new write-off methodology for unsecured loans.
So the wholesale cases are your standard corporate credit risks, right? Likely a few very large corporate clients or mid-market enterprises that just defaulted.
Things happen.
Yeah, things happen, but the inventory adjustment for a new write-off methodology, that is where the strategic cleanup is really happening.
How so? What does that methodology change actually mean?
Well, banks operate on highly regulated actuarial models that dictate when a loan must be classified as a total loss. By changing their write-off methodology, management essentially looked at their historical recovery models for unsecured debt, realized those models were overly optimistic given the current macro environment, and they just moved the goalposts.
They shorten the timeline.
Exactly. Instead of letting a bad loan linger in a non-performing purgatory for a year while debt collectors make phone calls, the new methodology rips the Band-Aid off faster.
Right. And by implementing this stricter rule, a massive batch of legacy unsecured loans suddenly cross the threshold into write-off territory simultaneously.
It's an accounting flush. They are deliberately taking the pain today to clear the decks for the new collateralized portfolio.
And the ongoing pressure from that legacy portfolio is still highly visible in their non-performing loan ratios, the NPLs. They noted a 29 basis point adjustment in their NPL classification, specifically calling out the agribusiness portfolios and those legacy low-income individual clients.
Yeah, and the agribusiness pressure makes perfect sense when you look at the broader Brazilian economy right now. Small and mid-sized farmers are highly exposed to climate volatility and global commodity pricing.
Right, so when crop yields drop,
or input costs like fertilizer spike due to global supply chain issues, that SME agricultural sector gets squeezed instantly.
And cash flow just dries up.
Exactly. And the NPLs on tractor financing or operating lines of credit start ticking up.
But the consumer side of those NPLs brings up a really fascinating dynamic regarding government intervention. An analyst on the call, Mario Pieri, brought up the Desenrola program.
Ah, right, Desenrola.
Yeah, this was a massive, highly publicized initiative launched by the Brazilian federal government, specifically designed to renegotiate consumer debt and bail out the over-leveraged mass market.
Right. The theory was that government-backed guarantees would allow banks to renegotiate bad loans, clean up consumer credit scores, and stimulate the economy.
So you would assume a program like that would be a massive tailwind for a bank trying to clean up a legacy subprime portfolio, right? I mean, free government help.
You'd think they'd jump at it.
But management's assessment of the program was brutally dismissive. Muniz stated flatly that the Desenrola program didn't move the needle for Santander Brazil. The government threw them a lifeline, and the bank essentially ignored it.
And they ignored it because the mechanics of the government program conflicted directly with their internal de-risking mandate.
Right, explain that conflict.
So government debt relief programs often target the symptom, which is the outstanding balance by extending maturities or artificially lowering rates. But they don't fix the underlying disease, which is the borrower's lack of structural cash flow.
Because they still don't make enough money to pay the new, lower rate.
Exactly. Santander recognized that participating heavily in soft renegotiations would just kick the default down the road.
And Muniz used a phenomenal term for this on the call. He said Santander absolutely refuses to do smoky renegotiations.
Smoky renegotiation.
Yeah. Let's break down the mechanics of what a smoky renegotiation actually is, because it is a classic banking trick.
Oh, it really is.
So let's say a client defaults on a $10,000 raise unsecured loan. The bank is supposed to classify that as a non-performing loan and take a provision hit against their capital reserves.
Right, which hurts profitability.
But if the bank calls the client and says, hey, we will extend the maturity of this loan by 5 years and lower your monthly payment by half, the client obviously signs the new paperwork. And magically, that loan is reclassified from non-performing back to performing.
Right. So the accounting suddenly reflects a healthy asset, and the bank avoids taking the immediate provision hit, but it is entirely smoke and mirrors.
Because the borrower is still functionally insolvent.
Yeah. Exactly. They don't have the cash flow to sustain even the lowered payment. And 6 months later, the loan defaults again. The bank didn't fix the balance sheet. They just manipulated the timeline of the loss.
And Santander is explicitly rejecting that accounting manipulation. Their current stance on renegotiations is incredibly aggressive. Muniz stated that to formalize a debt renegotiation, the bank is actively requiring the borrower to post additional collateral or provide a cash down payment.
I mean, that is the definition of playing hardball.
Totally.
If a borrower is drowning in unsecured debt, they likely don't have cash to put down. By demanding skin in the game, like a vehicle title, a piece of equipment, or immediate cash, Santander is purposefully disqualifying a massive percentage of their defaulting clients from renegotiation.
They are essentially telling the borrower, if you can't collateralize this debt today, we aren't going to pretend you can pay it tomorrow. We're just going to write you off, send you to collections, and take the hit on our books right now.
And this hardball tactic is exactly what is driving the short-term pain in their NPL ratios and their provisioning costs. They are bleeding today because they refuse to apply a fake tourniquet.
But the long-term mathematical result of this strategy is an ironclad balance sheet. The loans that do successfully move through this strict renegotiation funnel are backed by hard assets. The bank is trading short-term accounting volatility for long-term structural integrity.
Which transitions us perfectly into management's guidance, because retail investors looking at this stock need to know how long this structural renovation is actually going to take.
Right. When does the pain stop? When does the new de-risked portfolios start driving the top line again?
And the answer provided by the CFO was pretty sobering. An analyst asked specifically when revenue and risk-adjusted margins might start showing meaningful improvement. And CFO Carlos Muniz responded, "Personally, I'm not very optimistic."
Wow. The sheer rarity of a chief financial officer expressing personal pessimism on a public earnings call, you just cannot overstate how unusual that is.
No, earnings calls are usually masterclasses in corporate spin.
Everything is always transitory or creating opportunities.
Exactly. So for the CFO to flatly dampen expectations and signal that an immediate recovery in risk-adjusted net interest income is unlikely until closer to 2027, that shows a profound level of operational conservatism.
It tells you everything you need to know about the internal modeling happening at the bank. They aren't hoping for a macro miracle. They are mathematically bracing for impact. And to understand why they are so pessimistic about the immediate future, we really have to look at the regulatory provisioning models they are forced to use.
Right, because Mines specifically referenced the upcoming Brazilian elections as a major factor in their conservative outlook.
Now, we're looking at this purely through the lens of financial mechanics. We don't take sides on the politics here.
Right, strictly the math.
But in emerging markets, electoral cycles inherently inject massive volatility into the yield curve and fiscal policy expectations. Will the incoming administration run a massive fiscal deficit? Will they attempt to artificially manipulate the Selic rate? Will they launch inflationary social spending programs?
And that policy uncertainty directly impacts the banking sector through a regulatory framework known in Brazil as CMN 4966, which is heavily aligned with the global IFRS 9 accounting standards.
Okay, let's unpack those standards. How do they work?
Well, under the old accounting rules, banks used an incurred loss model. They didn't have to take a provision hit until the borrower actually missed payments.
Makes sense.
But the new standards require banks to use expected credit loss, or ECL models. And these models are entirely forward-looking.
I mean, they don't wait for a missed payment.
Exactly. They require the bank to feed macroeconomic forecasts, things like GDP growth, inflation, unemployment, interest rates, into an algorithm. If the algorithm dictates that the macro environment is going to deteriorate over the next 12 months, the bank is forced to increase their loan loss provisions today.
Even if their clients are currently making all their payments on time.
Even if every single client is perfectly current.
Wow. So when Yunus says he is not optimistic because of the upcoming elections, he is telegraphing that the bank's internal macro forecasts are flashing red.
Yes. They expect to have to feed worsening economic inputs into their ECL models, which will mathematically force them to take higher provision expenses over the coming quarters, suppressing net income throughout 2025 and 2026.
They are heavily padding the lifeboats before the storm even hits the radar.
Precisely.
But nestled inside this pessimistic timeline was a very specific, highly technical signal regarding when the turnaround will actually materialize.
The DTAs.
Yes. Management noted that they expect the turnaround and the consumption of their deferred tax assets, or DTAs, to happen between 2027 and 2028. We need to unpack the mechanics of a DTA because it is the ultimate leading indicator for a bank's internal profit projections.
Yeah. A deferred tax asset is essentially an accounting mismatch between the bank's internal books and the tax authority's rules.
Okay.
So when Santander takes a massive provision for a bad loan today, they reduce their reported net income, which ideally should lower their tax bill.
Because they made less profit.
Right. However, the Brazilian tax authority often says, we don't care about your internal ECL models. You can't deduct that loss for tax purposes until the loan actually legally defaults. So the bank pays taxes today on a higher profit figure than they actually reported to shareholders.
Got it. So they basically overpay their taxes in the present.
Yes. And in return, they get a DTA, a tax credit that just sits on their balance sheet. If they generate a massive profit in the future, they can apply that DTA to wipe out their future tax liability.
But here is the catch. A tax credit is completely worthless unless you are generating enough taxable income to apply it against, right?
That is the critical deduction. When management explicitly guides that they expect to consume these DTAs between 2027 and 2028, they are subtly but firmly signaling to institutional investors that is the exact window when our new de-risked collateralized loan portfolio will reach scale, our provisions will drop, and our structural profitability will surge so high that we will finally burn through these accumulated tax credits.
It is a roadmap. The pain lasts through the 2026 election cycle and the explosive profitability returns in 2027.
Yep.
And while investors wait out this transition, the bank is quietly building the infrastructure to ensure that 2027 surge actually happens. The metrics around customer loyalty and technological lock-in are really the silver linings of this quarter.
Yeah, let's look at the transactional deposits. Despite shedding 30% of their low-income base, overall transactional deposits are up 18% year over year.
Which is phenomenal.
It proves that the primacy strategy is actually working. Transactional deposits, the money sitting in checking accounts being used for daily expenses, are the cheapest form of funding a bank can acquire.
Because they don't pay interest on it.
Exactly. So growing the space by 18% while simultaneously shrinking the mass market credit portfolio means they are successfully convincing their high-income and SME clients to use Santander as their central financial hub.
And they're building a moat around that hub with Santander Rewards. They launched this new loyalty program, and already 15% of the eligible base is enrolled.
And the early data shows increased engagement and higher card spending among those cohorts.
But the most powerful lock-in mechanism mentioned in the transcript revolves around PIX. They reported a 30% increase in registered PIX keys.
PIX is huge.
Yeah. To understand why this is a massive leading indicator for long-term profitability, we have to look at how PIX completely rewired the Brazilian financial system.
So PIX is the instant payment system created by the Central Bank of Brazil. It operates 247, settles instantly, and is just universally adopted.
Right.
Before PIX, transferring money between different banks in Brazil required using TED or DOC transfers, which came with heavy fees and time delays. PIX essentially obliterated the traditional debit and credit card interchange fee models for basic transactions. You can literally buy real estate with PIX, or you can buy a coffee on the street corner.
And initially, banks fought PIX because they were terrified of losing that massive interchange fee revenue.
Oh yeah, they hated it at first.
But Santander realized that the real value of PIX isn't in transaction fees, it's in structural lock-in. A PIX key is usually a customer's mobile phone number or their national ID number. If a customer registers their primary PIX key with Santander, it means every single time someone sends them money, a friend paying them back, a client paying an invoice, an employer sending a bonus, that capital automatically lands in their Santander account.
It embeds the bank into the fundamental routing layer of the customer's economic life. The friction required to move your primary PIX key to a competitor is incredibly high because you have to update your payment details with literally everyone you do business with.
So by growing their registered PIX keys by 30%, Santander is aggressively hoarding the destination endpoints for the Brazilian economy's daily cash flow.
Exactly. They own the routing number, which means they own the deposit float, which gives them the cheap funding they need to offset the lower spreads of their secured lending strategy.
The architecture of the turnaround is honestly brilliant. But for a retail investor, the question remains, why hold the stock today if the macro environment is terrible and the turnaround doesn't hit until 2027?
The answer lies in the ultimate silver lining, the dividend promise.
Right, the dividend.
In emerging market banking, dividend consistency is the anchor that prevents institutional capital flight. Despite the 12.5% ROAE, despite the compressed margins, and despite the CFO's pessimism about 2026, management emphasized an ironclad commitment to maintaining their 50% payout policy benchmark for the long term.
They are committing to distributing half of their net income back to shareholders.
Yes. And Muniz even noted a fascinating mechanical detail. Because raw profits are slightly pressured right now due to the heavy provisioning, the actual payout ratio might technically float a little over 50% in the short term, just to ensure the absolute cash value of the dividend remains stable for investors.
So they are prioritizing the investor's cash flow over hoarding every single cent of capital.
That is a massive signal of underlying institutional confidence. A bank that is fundamentally terrified of insolvency or structural collapse does not promise to dividend out half its profits.
Right.
A bank that is confidently taking calculated strategic medicine to clean up a legacy portfolio does. They know their capital ratios are robust enough to withstand the de-risking process while still paying investors to wait.
Okay, we have covered immense ground today. We've dissected the macro squeeze on the CDI, the aggressive 30% amputation of the subprime portfolio, the pivot to highly collateralized lending, the hardball tactics against smoky renegotiations, and the timeline for consuming those deferred tax assets.
It's a lot to process.
It is. But it is time to synthesize all these data points and deliver the bottom line. Based on the mechanics we've unpacked, what is the actionable takeaway for you, the retail investor looking at BSBR today?
Well, the verdict requires splitting the investor base into two distinct camps because this earnings call sends completely opposite signals depending on your time horizon.
Let's start with the short term. If you are a short-term momentum trader looking for explosive growth, someone hoping for a massive revenue beat next quarter that pops the stock 20% time, Santander Brazil is a screaming bearish signal.
Totally bearish.
The strategic mechanics dictate that the top line will remain sluggish. They are intentionally suppressing loan origination in the mass market. They are hoarding cash and demanding strict collateral from borrowers, which inherently slows down growth.
Plus, those forward-looking ECL provisioning models will continue to act as a heavy drag on net income as they bake in the volatility of the upcoming Brazilian elections.
Right. The short-term chart is likely going to be flat, choppy, and highly sensitive to negative macro headlines. The short-term thesis is dead.
But if you look at this through the lens of a long-term dividend investor, the narrative completely inverts. It becomes incredibly bullish. The strategic moves management is making are exactly what you want a mature financial institution to execute in a toxic macro environment. They are refusing to chase unprofitable market share. They are aggressively shedding high-yield, high-risk, unsecured debt before the macro environment deteriorates further.
They are rejecting the accounting tricks of smoky renegotiations and taking the painful provision hits today.
Exactly. And by doing this, BSBR is building an absolute fortress of a balance sheet. They are willingly sacrificing the vanity metrics of growth to ensure that when the macro environment inevitably stabilizes and the consumption of those DTAs in 2027 kicks in, their collateralized loan book will be pristine.
Their funding costs will be anchored by PIX deposits, and their AI-driven operational costs will be leaner than ever before.
It is a textbook value investing setup. The 12.5% ROAE is the floor here, not the ceiling. And while you wait for that 2027 structural recovery to materialize, the bank is paying you a massive dividend via that 50% payout ratio to hold the stock.
You're getting paid to wait while management does the hard, unglamorous work of structural de-risking.
It is a really compelling thesis for the patient capital out there.
It is. But before we wrap up this deep dive, the raw data inside this earnings call raises a much larger, frankly terrifying question that extends far beyond the equity performance of Santander Brazil.
Because the data always tells a story about the real economy.
Exactly. Think about the asymmetrical information at play here. Santander Brazil is one of the largest, most sophisticated financial institutions in Latin America. They have access to real-time consumer spending data, proprietary AI risk models, and macroeconomic forecasts that retail investors can only dream of possessing.
They can see the exact cash flow of millions of citizens.
And what is the conclusion they drew from all that proprietary data? They decided to drastically, aggressively cut off credit to anyone making under 4,000 reais a month. They walked away from 30% of their mass market exposure. They are demanding hard collateral for every single renegotiation, and their CFO is openly bracing for a worsening macroeconomic scenario.
They are looking at the horizon, seeing a massive storm, and violently battening down the hatches.
So here is the thought to leave you with. If the smart money, the institutions with the most accurate data in the country, is acting this defensively, what does that signal about the hidden fragility of the everyday consumer economy?
It's a chilling thought.
If a mega bank is looking at the mass market and deciding that lending them money is mathematical suicide, shouldn't everyday retail investors be looking at their own household balance sheets and doing the exact same thing?
Right. If the banks are aggressively shedding unsecured debt and building fortress balance sheets, maybe it's time for the everyday consumer to aggressively pay down their own credit cards, avoid taking on uncollateralized leverage, and build a personal fortress balance sheet to survive whatever macro volatility is coming next. It is a vital macroeconomic warning hidden in plain sight within a corporate earnings transcript. When the banks stop lending to the middle class needs to stop spending.
We started this deep dive talking about the expectation of linear growth, the idea that more customers automatically equal more success. But today, the mechanics of Santander Brazil prove that sometimes the smartest way to grow a business, and perhaps the smartest way to manage your own finances, is to aggressively shrink the parts that are silently killing you.
Couldn't agree more.
Understanding the why behind the raw numbers is the ultimate shortcut to staying well-informed and ahead of the curve. Keep digging into the data, keep questioning the consensus, and we will see you on the next deep dive.